Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. In this weekend show, well, we get to talk about all the volatility, not just in U.S. markets, but really global financial markets, all kicking off at the start of the week with that big fall in the Japanese markets, and other markets around the world followed suit, not to the same degree. And then we saw a little bit of a rebound. Boy, oh boy, this summer, anything from boring or slow. In the first half of the show, we'll focus more on the markets globally. Second half of the show, we'll get a bit more into some of the commodities and resources. To kick off this show, we are chatting with Mike Larson, editor-in-chief at MoneyShow. We'll post a link in the show notes to the MoneyShow website where you can find out all about their upcoming conferences, all of which Mike attends, speaks at, and summarizes what he hears for us from all of the speakers. Mike, let's start off with the markets. I have to ask you, just the action this week, which really is a carry forward from about 3.5 weeks ago when markets started to roll over close to the start of the third quarter. You have been on the show saying that this is still a market to be bold. You don't need to be defensive. Have you changed your tune at all?
Yeah, glad to be here. Thanks for having me on. It's funny. I got a friend of mine who works for a big bank in the money management, wealth management side, and he always says, "Will you please tell me when you're going out of town? Because it seems like every time you go out of town, the markets fall apart." And sure enough, the curse held. We had our event in Vegas last week. Flew out on Tuesday. Flew back on the red eye Saturday night into Sunday. And well, I guess a few things happened in the market while I was at that event. So yeah, it's been a mess, some crazy 96 hours of trading, basically. If you start from Thursday morning of last week through Monday night, basically, the markets got kicked in the teeth, let's be honest. But it's funny how the narrative shifted just in that same 96-hour period. On Wednesday, after the Fed got done meeting, and they came out and did nothing, and Powell did his conference where he sort of laid the groundwork for an eventual cut, everybody was celebrating. Wall Street was throwing them a ticker tape parade, saying, "This is great. The Fed didn't need to cut. Everything's fine." Now the stock market starts falling on Thursday, and then Friday, what happens? You get this lousy jobs report in the morning, and the market just falls on its face, and the narrative goes from, the Fed can wait till September to cut, to, holy cow, they need to do a cut quick. And then, of course, over the weekend, Sunday night's action in Asia, and then Monday morning over here, it was not just the Fed. It didn't shift from just the Fed was fine to sit tight till September to maybe the Fed should have cut, and it's a little behind the curve with this jobs report, to holy cow, everything's going to hell in a handbasket. The Fed's got to cut 75 basis points before I finish the sentence. So it's really a really big sentiment shift. And now, as we're speaking, what's happened? The Japanese markets basically regained everything that it sold off or lost in that sell-off, which, let's be honest, was shockingly bad. I mean, it was the worst day for the Nikkei in Japan since the 1987 stock market crash. So kind of odd for that big of a move. But the Bank of Japan did probably one of the biggest about faces I've ever seen in 25 plus years of tracking central banks and interest rate markets and so on, and said, "Yeah, we screwed up. Sorry, forget what I told you. We got the message. We're gonna be fine." So you already seen the Bank of Japan do that. You did not see the Fed come out and do anything, which, if you go back to even the Greenspan days in the late 1990s, whenever long-term capital management and some of the other crises after that, they always have this modus operandi of waiting until you get like a triple witching Friday or something, or 8:30 when certain markets would open, and they'd come in and say, boom, we're going to do a surprise interest rate cut. And the idea was catch the markets off guard, catch the markets that are super short, and so not only give them a fundamental catalyst to change the narrative, but also do it at a time that would have the biggest bang for their narrative buck. We didn't get the Fed to do that this time, which actually, I would say, arguably, especially based on that labor market report, that the Fed should have probably cut, at least gotten the process started. Why wait till September? It's not just that the jobs market was bad, or jobs report was bad last Friday. It was also that the sum total of the data has shown inflation's come down a lot. In my presentation, I basically said we're having a half off sale, right? Because the core CPI has gone from 6.6 at the peak to 3.3 year over year in the most recent month. Is that too? No. Is it heading towards that? Yeah. Is it coming at the same time as you're getting not just that labor report, but a lot of data that's suggesting the economy is slowing? Labor slack is picking up. It's not falling apart, but it's picking up. So why wouldn't they? What's the benefit of waiting to September? I didn't And again, having been in this game long enough, just like you guys, there's what you think the Fed should do with quotation marks around it and what you think they actually will do with no quotation marks around it. And I didn't think they would cut in July, but I thought they probably should. They didn't. We got that report. We got the market sell-off. And now the Fed's kind of sitting there with egg on its face. And frankly, I don't think there's any reason. A lot of people say, oh, they only do emergency cuts in times of extreme crisis. I would say, don't be reactive. Don't wait for the extreme crisis. Admit you kind of screwed up on the economic front and say, you know what? Between some of the volatility and what we saw, yeah, we're going to give you that 25, and then we'll see what happens in September. Whether that happens, now it's obvious they're going to wait until to see what happens. But because they didn't go and try and get back ahead of the narrative, which I think they should have, I wouldn't be surprised if the market rolls over again. I don't know if it's going to be today, tomorrow, next week, a couple of weeks, but I think arguably we're probably going to have some seasonal weakness that we always kind of have in August and September. It's going to be worse because the Fed didn't do what the BOJ did and admit it screwed up. And so that means it's going to be a more volatile period for the market, and we're probably going to maybe get at least one more good downswing. Longer term, though, and this is what I would tie it up with a bow. Longer term, no, I don't think it's go back to be boring when it comes to investing. I don't think be bold is dead because I put what's happened into the market event bucket, not the economic credit event bucket.
That's a good distinction, Mike, and I liked what you said there about the difference between what the Fed should do and what the Fed would do. And yeah, it was probable they weren't going to cut in July and probably will in September, but they probably should have gotten in front of it, especially because there was other central banks that had already started the process, like the Bank of Canada, and also what we saw out of the ECB. So there was already some cover to go ahead and start the cutting process. They didn't take that. But one person that I respect a lot in the market has been writing about maybe the reason they didn't is that the central banks do talk. And if the Fed had started cutting, is it possible that could have lowered the dollar, given the yen even more rise against the dollar, and exasperated what we're seeing with the yen carry trade unraveling and people having to sell dollar-based assets as they convert it back over? Do you think that factored into it, that maybe they didn't do that because of the effect it would have on currency markets and it would actually exasperate the yen-dollar spread?
Yeah, these guys obviously do talk, not just in times of crisis. Of course, you back in the great financial crisis, what happened? They did announce these swap lines, and it would be like, it wasn't just the Fed doing it, the BOJ, the ECB, blah, blah, blah. Everyone would line up. So it's possible. It's possible there was more that we're not seeing or hearing, or we don't know because we're not at that table. We're not in the room that it happens, to use the Hamilton line. So it's possible. But if that was the case, well, what they thought would happen isn't what happened, is it? So if their goal was, let's do it this way in a certain sequence because that'll avoid roiling dollar yen and markets, well, I would say that plan didn't exactly pan out. So now that's happened. I don't see any reason for the Fed not to do something. But again, do I think they will? No. Do I think they probably should? Yes, because I think it's stupid to say, well, there's not a crisis yet, so let's not do something. It's like, well, you're kind of going to make it a crisis if you don't do something, right? So whatever works. But I will say again, when I call it a crisis, I think the operative things in past market history to keep in mind. I mean, I've been at this for 25 years or so obviously I wasn't trading bonds or stocks back in the 80s, or I was born in 1975. So when I say recent, I would say my history of following the markets, writing about them, following central banks, whatever, this seems most akin to either the 1998 long-term capital management situation or the 2011 kind of debt ceiling stare down and U.S. credit rating situation that we had, more so than the start of the dot-com bust in 2000, or more so than the start of the great financial crisis in 2007. I think so. When I talk about the distinction between a market event and an economic/credit event, the latter, the economic credit event, is much worse, much longer lasting, the result of years and years of built up excesses and stupid behavior and risk that gets throughout the financial system, and then it goes bust. And you have long-term bear markets, you have people losing money left and right, bankruptcies, recession, blah, blah, blah. We had that, right? We had that from 2000 to 2002. We certainly had it from 2007 to 2009. Whereas this, to me, looks more like you go back to 2011, the Republicans and Democrats, the Obama administration couldn't agree on the debt ceiling. Boehner, or whatever, was the House of Republicans, Speaker of the House, I think, at that time, House of Representatives, excuse me. And what ended up happening? The Dow plunged, the S&P plunged. We lost a few thousand points in the span of a week or two in August of 2011. I forget, I think it was S&P that put the U.S. on credit watch or something. And it told Washington, holy cow, we got to get into gear. And within what, like how many days did they agree to pass a rate rise in the debt ceiling? And it didn't turn into an economic event. You lost a lot of money in a short period of time. If you were excessively long, you got smacked around. But did that mean the end of the sort of post-Great Financial Crisis economic expansion? No, it didn't. And we had several years of bull market. Then you go back to 98. I mean, that summer of 98 with the long-term capital management, the hedge fund that had put all these bets into the bond market. It was betting on spreads between U.S. treasuries and riskier debt doing one thing. They started to do the exact opposite. There was so much leverage involved that the fund was blowing up. It dragged the Dow down, the S&P, the NASDAQ, whatever. And basically the Fed got all these banks and brokers that had lent money to this hedge fund, got them in a room, locked the door and said, we're not leaving until you figure this out, and we'll backstop what you do to figure it out. And I forget what the total bailout size was. Gosh, it was like $5 billion, which back then was huge money. Now it's like a rounding error. Anyway, the hedge fund people got broomed. A few people lost their jobs. Greenspan cut rates 3 times in a row for 25 bips. And then we had one of the biggest bull runs ever at the end of 98 and 99. Obviously, that ended up blowing up in 2000. But the point being, it wasn't the end of the bull market. It wasn't the end of the 1990s expansion. That came later. I would say that's kind of how I think things are here. I think this is something that policymakers can, quote unquote, fix if they get their heads out of the you-know-whats and do the right thing for what the data is showing and what the markets are showing. So to me, and I would also say, sorry, I'm going on here, but I got a lot of thoughts on this. I would also say, if you go back to what was happening in early July, before this Japan stuff happened, what was happening in the markets? All of this, oh gosh, it's just a big tech move, and you can't have a market that's going to keep advancing unless it broadens out. Well, what happened in the first couple of weeks of July? The market broadened out. Tech retraced, money rotated into small caps, value, financials, REITs, home builders, the list goes on and on. I mean, even, it's funny, I put a chart in my slide from the presentation I gave on Thursday. And it was basically said, when is a 2% drop not really, in quotes, a 2% drop? And that's that day on July 24th, the S&P was down about 2%, but 165 stocks in the S&P closed up, which was the most for a 2% down day in more than a decade. So bottom line, until this Japan stuff happened, yeah, the market was selling off. It was pretty much all the top-heavy stuff that everybody was warning about anyway, and the bottom stuff was picking up the slack, which is what you want to see. So I think that still makes this look like a rotation, not a rollover move, even as seasonally speaking, because of kind of the way this is shaking out. I got smart people that I follow, MoneyShow speakers, that are saying, look, it might be a rough couple of months. I can't really argue with that now, given what we've seen.
What a great stat, though, that down 2% day, but the rotation, something that, look, we do see in markets, and it kind of gets shaded by the fact when people look so much just at the indexes. Mike, I want to go back in time a little bit, back to that Vegas show, because if you're not bearish on these markets now, you've laid out many reasons why you're not. Look, we have people in our audience. I see comments on our website. I see comments on our YouTube page. They're bearish. They think a big crash is coming. You outlined 5 reasons. You had a checklist of what would turn you bearish. Can you share those 5 points with us, please?
Yeah, absolutely. I mean, essentially, it comes down to that distinction between credit event versus big economic catastrophe. And so I had the 5-point checklist started with number 1, Fed sits on sidelines too long due to inflation worries. I kind of say that's maybe half checked off, because the Fed, again, given what we know now, if the Fed, and I assume the Fed didn't have the jobs numbers, because I have to think that there would have been a lot more push for a July cut had the Fed had those numbers Wednesday when it was meeting versus Friday morning when they came out. So I'd say maybe you could kind of put a half check there. Second item on my list was CRE problems, commercial real estate, and or credit concerns escalating notably. Because elsewhere in the presentation, I pointed out junk bond spreads have been coming down for months and months on end. The latest data out of the Fed itself, where they go out and survey banks and they say, hey, are you getting tighter or looser with your credit standards? And they do that across pretty much every category of loan there is. CRE standards have gotten less bad for two surveys in a row, which is every quarter. So for like the last 6 months, you have less banks that are tightening standards. It's kind of almost back to that middle line between tightening and loosening. What does that tell you? It means the banks themselves are saying, you know what, maybe the worst of this is behind us. So I would say that's absolutely not been checked off. I think that's still a go for bullishness. The third one, though, is kind of funny. Currency crisis strikes, parentheses, yen question mark. Well, I'd say that's a pretty big check mark for that item number three on my list because, again, I put this together probably a week before the show. Then obviously we all know what happened since then. So, yeah, you could argue we're in the midst of a currency crisis of sorts. So, yeah, so that's a bearish thing. So you got three items in. You got one that's a half check, one that's no check, and one that's a check. The other two, though, the fourth one was geopolitical tensions boil over, and I kind of had like China, Taiwan question mark. I would argue that, look, it's a sad situation. I don't want to downplay what's happening in the Middle East, but unfortunately, it's been going on for years and years and years. The markets can deal with it as long as it doesn't turn into some huge wide shooting war. It is a low grade conflict. What would spook the markets and lead to a bigger reassessment of risk would be if China and Taiwan got into a hot war, or China and the US got into some kind of crisis. That's not happening, so I would say that's no check there. And finally, the last thing I said, I called it the July jolt. And again, because this is before obviously what happened in the last sort of 96 hours of trading, I said, does the July jolt start looking more like a rollover signal versus a rotation move? The thing is, you can't tell that without watching the markets for a while. Everything that I'm seeing still tells me this is rotational, not rollover. So one item definitely checked off, one kind of a half check, the other three not checked at all. I think it's enough to still say it's not really a time to make a big flip. Like, this is it, folks. We're turning to a bear market now, get super defensive, blah, blah, blah. I think it's more kind of a seasonal thing that's got a catalyst that's going to make it more volatile and maybe a little bit of downside action over the next month or two. But I don't think that that's going to last. Again, the important point that I would make, big picture, you don't, in my opinion, or I at least don't do a lot of flip-flopping because when I'm generally speaking at these things and when I talk to you guys, I'm talking long-term. I'm not talking what's going to happen the next week or two or month or whatever. It's what do you do with your long-term money? And I don't think you make flips from bold to boring and back again very often if that's what you're talking about time frame wise. And I just keep hammering home the point. The time to be bearish, defensive, whatever, was in 21 and 22 when defense was outperforming offense, when all these garbage SPACs and garbage.com like companies were falling apart. I mean, we all say, okay, the market kind of had a rough 2022. People say, where's the bear market? We haven't had a bear market. I'm like, well, yeah, we kind of did in 22. And by the way, the stuff behind the S&P was so much worse. I mean, that was like dot-com level carnage in wide swaths of the market, and even the averages did poorly, and so did pretty much everything else, including bonds, except for gold. So we've had the bear market, in my opinion. Now it's just more of a digestion, rotation, indigestion, maybe even for a while, but I don't think this is a rollover at this point. That's not what I'm looking at. Even if we're rolling over intraday as we're speaking, which that doesn't surprise me because the Fed dropped the ball.
Well, Mike, just following up on that comment about staying with the be bold versus going to the be boring and more of the safety play, we have had a lot of people on the show as generalists say that they are getting more concerned about a recession, and they've been flagging a lot of the value sector stocks, things like healthcare, like the REITs, like gold, like bonds, and even going to cash as strategies. And they weren't talking about that 3 months ago or 6 months ago or a year ago. And so there does seem to be some rotation, speaking of the money rotation, into the value sector and out of growth. And we have seen some of the big mega cap tech stocks roll over. But we are seeing the other side of it. We're still seeing speculative things in the cryptos and even in some of the meme stocks. And we are still seeing things like the small caps, as you pointed out, starting to rally a couple weeks back and doing better than they had before this recent market corrective move. But is there some investors moving to being boring again? Because the value sector seems to be picking up steam.
I think what you're saying, value to me, again, doesn't necessarily, I mean, there's some stuff that's quote unquote boring within it, whether it's utilities, whether it's REITs and so on. But I think you got two things going on. REITs and rate sensitive stuff, yes, it's rallying because we've seen interest rates come down. Plus, you're seeing bargain hunting going on in a sector like REITs, for example. REITs have been lousy for how long? REITs have been sort of the whipping boy for ages now, almost 18 months. Simply because of the story that nobody's ever going to go back to an office, nobody's ever going to go to a mall, every apartment on every block in America is empty, and rents are going to tank, and the buildings are going to lose 50% of their value, blah, 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 blah. You've had all that stuff going on, which is why that sector, I think I would argue, is part of this sort of rotation into new things that are going to do well. What's the next thing to advance? So if it was just something like sorry, if it was just something like the REITs, if it was just something like utilities, okay, then I could see that maybe that's sort of a boring trigger. But financials have been improving, materials, industrials have been improving along with this rotation. So it's not just the defensive stuff. It's more like a value slash capitalization slash non-tech hunt for new things that's been going on. While you're talking, I was just calling up various screens. It's like now, I mean, you've got things like in the last 30 days, this market's been down. XLI is up a percentage point. The basic materials is up about a percentage point. Financials are up a little less, even as the Qs are down 10%. The tech sector is down 13%. And yeah, the utilities are up more and the REITs are up more, but it's not just the super defensive stuff that's up. It's other things that are just basically non-tech. So that I'm okay with. And again, could that change? Sure. Could I be wrong and this is rollover versus rotation? Absolutely. And if I see more indicators of that, then yeah, I'm going to change my story. But right as of now, it's not looking that way. That's not my base scenario. I don't think it's going to be for the rest of this year.
Are there any other sectors that aren't on other people's radar that you think are maybe just starting to pick up steam here in this whole rotation trade?
I think REITs are going to probably be one of the best performers, because again, I talked about the bank lending situation. I'd also talked about the fact that they haven't done anything for a long time except go down. And I think that the mainstream media attention, everybody hates that sector. So you throw all that together, plus you add in lower interest rates and a Fed that's going to be cutting for the next 12 to 18 months, probably. Holy cow. I mean, that's one of the sectors I think really looks super attractive. I would look at things like financials. I would look at things like transports, industrial, some of the stuff that as the recession fear fades, if I'm right, and it's more of a soft landing versus recession, that kind of stuff's undervalued, especially relative to tech. And I don't think I mentioned this last time we talked. We had a hot take thing on Twitter on the X Spaces about at the beginning of July, and it was just name 5 things you think could happen that are not like completely out of the blue, like aliens are going to land and take over the Earth or whatever, but that things that could happen in the markets that would be surprising but not completely unrealistic. And a couple of mine were, at the time, TLT was down, the long bond ETF was down about 3% on the year, and I said, you're going to finish up 4 or 5% on TLT by the time the year is over. We're about break even on that, so we'll see if that happens. And I also said, if you measure it from the start of the second half, IWM, the small cap ETF, will outperform QQQ. Now, I had no idea it was going to be such a violent rotation a few days later. It was more like this is going to happen over the span of 6 months, not 6 days. But obviously, we saw that where we've retraced some of it. But even now, in the last 30 days, IWM's given back some ground, but it's still up 0.9% in the last 30 days, whereas the Qs are down 9.9%. I think that kind of performance gap is going to be the story because, again, it's rotational, not rollover. And again, we'll see if that's right or wrong, but that's still kind of my story, and I'm sticking to it.
Well, Mike, let's also get your thoughts on the commodity sector. We have really kind of a bifurcated market where gold is up and almost all the other commodities are down. When you look at copper, when you look at oil, when you look at a lot of the base metals, even when you look at silver, the industrial component, everything's down, gold's up. What do you make of that environment?
Yeah, I mean, look, we've talked before. I've been on the bullish bandwagon for gold since the back half of 2018. And for a while, it was just like, sitting there poking it, waiting for it to do something. And now it's doing a lot more than something. I think that continues. If you've got a Fed that, I mean, we all know if you're a commodity specialist, you know that gold is almost pure monetary. Yes, there's a jewelry component to it and some other things, but it's the most monetary metal you can find, whereas silver has the monetary component, but it has industrial uses and is tethered to some of the stuff that happens elsewhere in the commodity space. So gold, some of the people that we have speak at MoneyShows and some of the people I've interviewed are more bullish on silver. They think, it has the chance in a bull market to really dramatically outperform gold. And those people are smart people. So I don't want to downplay it. That could be right. But me, I slightly favor gold simply because, again, it's a monetary play. It's a safety play. It's a Fed cutting play. It's even now with all-time highs being tested, set, and then, a little bit of a pullback. Even now, try and find me a story where, you've got 20 investment managers being polled and 18 of them talk about gold, or, look at the fund flows. You're not seeing the euphoria that you've seen in past spikes for gold like you had in 2011, or even that you had at the most recent peaks before now in terms of gold running up. So I think from a sentiment standpoint, there's a lot to argue that it's still got more room to run. So I'm firmly on board with gold. I think with oil and some of the industrial things, I don't think it's going to be terrible. I don't think that there's like some global recession where everything's going to fall apart and that means you want to sell anything that's not gold in the commodity space. I just think that, yeah, you're going to have a little bit of, downside tether there. With oil, you got kind of a mix. I mean, some of it's political because let's be honest, if Trump wins, people say he's going to be super friendly for the energy sector, which is good if you want to drill. But if you're a drill baby drill and you're going to flood the market with oil because you're not going to have any regulation or restrictions or whatever, then that's something I think is kind of weighing on the market. People want to see how the U.S. election shakes out before if Harris wins or Trump wins. That's probably some of it. And some of it is just the U.S. production is very high. The geopolitics, I mean, the stuff going on in the Middle East, it doesn't hit as hard because there's so much production elsewhere in the world. And Russian oil is leaking out into the global markets too, despite sanctions. So a lot of reasons why I don't think we're in for a super spike type environment. I think I'm gently bullish. I think just while we're talking, I've coined a new term. I'm gently bullish the oil market.
There you go. I like that term. Just follow up, comparing, I guess, the gold stocks to the oil stocks with gold being so strong. And it has been strong for a while now. Why have the oil stocks done so much better than the underlying gold stocks when you look simply at something like GDX compared to XLE? Very different underlying components, very different underlying prices in those commodities. But why have gold stocks underperformed even when you just compare them to oil stocks?
Well, I think you're seeing some of that be corrected, right? It's funny as you're typing, I'm pulling it up on my screen now because of what's happened more recently. GDX is up about just a little over 13% year to date. XLE is up about or just under 7%. So earlier in the year there was definitely that going on. You're starting to see some of the mining shares pick up. I think a lot of the fear has been inflation. It's so damn expensive to go drill for gold and hire people to do it and this and that and the other. So even though the underlying commodity was doing better, are you going to be able to price for your costs and everything that's involved in getting gold out of the ground? So I think that was part of it for a while. And part of it is durability. Belief in the length and duration of this move and whether it's going to be a flash in the pan. Gosh, I got to stop with these puns, flash in the pan. And then the third thing I think is just mainstream money has not yet been convinced, but I think it's starting to get convinced. So when you look at the way big money is run, I mean, Newmont's the only gold miner pretty much in the S&P 500. The big money can't go out there and buy a bunch of junior explorers and smaller companies that are in this space. So it's going to take more like mainstream money, real retail saying, you know what, I'm giving you this money. I want you to put it in the sector. Go out and find me some freaking stocks. Once that starts to happen, that's when I think you see a lot of catch up. And it's an interesting conversation I had with Eric Balchunas, the ETF guy at Bloomberg Intelligence. He's speaking at our October event. I had him on the podcast, and I kind of asked him, I said, I would think since he follows things like ETF flows and sort of investor sentiment, I said, why have you not seen like money dogpiling into things like GDX and GLD? And he said, look, some of it's just this generation. If you're under the age of you know what your goal is? It's Bitcoin. It's Bitcoin ETFs. It's crypto, whatever. He kind of said, look, if you want to see where the euphoria is, it's people assuming that the younger generation of investors assuming gold equals Bitcoin. So if I want to buy protection, I buy Bitcoin or Bitcoin ETFs, and that's where the flows have been. I mean, I think it's pretty obvious that's kind of not the case. I mean, just look what happened on Monday when the markets were falling apart. Did Bitcoin trade like gold? No, it was down like 15% at one point on the day, along with stocks, because it was being treated more as a risk asset, whereas gold was down a little bit and it started the day up. So I think you kind of have to have the mainstream money trained to realize the differences. And I think that as those types of things happen, that's when you see a lot more catch up in that space.
Good distinction between what's happening in the cryptos and what's happening in the precious metals as far as price reactions to these markets. Just one more follow-up on the commodities, though, Mike. Is what we're seeing in copper, the rollover, and pretty hard from May down to August, is the rollover in aluminum, the rollover in zinc, the rollover in nickel, the rollover even in silver, indicating that we are getting recession? Are they indicating that we're getting into a contractionary environment?
You know, you got to keep that as a possibility in the back of your mind. But I think also one of the things that I always say with some of those commodities, so much of it is tied to Asia growth, China growth, and so on. I think, again, when you go back to mainstream money and you don't look at the small picture and some of the nuances, and you just say, what am I trading when it comes to big picture macro trend? It's a lot of China slow equals sell copper or sell commodities and so on. So I think some of it is that. Maybe I'm wrong. I don't think so. I haven't seen enough elsewhere outside of the commodity space to think it's more than that. I'll be watching, but I don't see a lot of reason to think that we're really at the cusp of some big rollover in the economy, in the markets, and so on. But if I see enough signs, then I'm certainly not going to keep telling the market it's wrong and I'm right. So at some point, you got to rethink what you're looking at. But I just don't think we're at that point, and I don't see a lot of reasons to believe we're at that point.
All right, Mike, great chatting with you. Always enjoyable hearing what your thoughts are on the markets, what you're hearing at the Money Show conferences. And hey, you have been kind of that level-headed commentator for us, leading us through the ups and downs of the markets over the past number of years. Right now, we'll keep note of that checklist that you had, those 5 points that would turn you bearish. Not bearish right now, it's still a rotation trade. Again, if you want to learn more about some of the upcoming Money Show conferences, click the link in the show notes. Mike, thank you so much for your time, everyone. Stick around. We're going to be right back, focusing a bit more on commodities.
Thanks, Corey. Thanks, guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And now we shift our focus still to the markets, but we're going to tie in a lot more of the commodity moves, especially in metals, as we are chatting with Axel Merk, President and Chief Investment Officer of Merk Investments. Axel, we have to start off with how you're viewing this broadly based correction in the markets. It's global that we're seeing this correction, and especially in the U.S., we're over 3 weeks into it. Monday was, I think, a scary day for a lot of investors as we saw the Japanese markets, the Nikkei, drop 12%. The U.S. markets followed, but they were down, let's say, 2, 3, 4% broadly, and then have been bought back throughout at least the first half of the week. Axel, do you think that broadly markets, not just in the U.S., but globally, are topping here?
Yeah, great to be with you. As we discussed offline a little bit, this seems very quote-unquote normal, as unusual as the move was, of course, in the Japanese market. Normal in the sense that it has the hallmarks of a market that is topping out. Volatility, the leaders of the previous move are getting tired, getting sold off, their rallies, volatility is picking up, and then there are very strong reversals. Obviously, what happened in Japan was somewhat extreme, but that's the sort of thing that you'd expect after a period of dampened volatility, that the positioning is such that people need to delever and you get margin calls and whatnot. And then suddenly the bids are gone. The markets these days the death is skin deep only. And so if there are sellers around, suddenly the buyers say, oh, no, thank you. Right? I mean, we got all these wonderful market makers keeping our spread super tight, but these guys don't want to take any risk. And so if somebody is a forced seller due to a margin call and whatnot, then suddenly the bids are gone. And that's a warning sign for other markets as well. And so gut-wrenching this might have been if one is invested in one of these markets. None of this should have come as too much of a surprise that this sort of stuff will happen. Also keep in mind, right, the Federal Reserve has been tight for a very long time, Bank of Japan easy for a very long time, and that creates an entrenchment of certain positions, a complacency. The carry trade always has been mentioned. That's a symptom of where we are. And yes, as volatility rises, then all hell breaks loose. But that's nothing too surprising here.
Well, and Axel, I was looking at a chart a buddy of ours sent over that shows Cisco in the dot-com era and what its chart looked like going into 99, 2000, 2001 as it rolled over. And they were overlaying NVIDIA with the Cisco chart and showing it almost on the exact same trajectory. And people have pointed to the Japanese carry trade unwinding as a big part of this, and that absolutely is a factor. But really, NVIDIA started rolling over. You could argue at the very beginning of July is where it peaked out, and it's been rolling over for weeks now. Do you see this as similar to the dot-com era in the sense that a lot of these valuations got to extreme levels and they started rolling over before more people actually got concerned, and it took weeks and weeks before people started saying, oh, maybe these things are rolling over?
Yes. So first of all, I can't, just because my speech is regulated, give specific advice on the video or any other of these securities. That said, one anecdote is the same people, literally the same people that told me in late 99 that they're buying certain tech stocks, told me a few weeks ago that they're buying certain tech stocks. And when I heard that a few weeks ago, I figured, well, this is presumably the top for NVIDIA. Obviously, we had some other signs of that with the CEO signing the breast of a woman at some conference. And that's also a sign that maybe we are a bit in topic territory here. I say that with the caveat that Greenspan warned about irrational exuberance in 1996, and it took until 2000 for the market to turn. One thing in 2000 was that even if one was concerned about valuation, predicting the exact top was very difficult. And obviously, the Nasdaq, I believe, topped in March, and the S&P, I think, might have been only in September. So I'm not the type of person who thinks that it's easy to market time to exactly get the top. And anybody who is a day trader and thinks they can do it, by all means, be my guest. To me, it's much more about risk assessment. Investors should be cognizant of the risk that we might be in a similar situation and stress test their portfolio accordingly. That's how I look at that. I'm just fine to miss out on another rally in some of these stocks. Let somebody else take those gains. I'd rather seek downside protection. And as more people are thinking along the same ways, that in itself then weighs on that segment. And then I think that's part of the reason why it's a process, this topping out process. The buying the dip mentality has to die. It will die very slowly. And that's precisely why these environments are similar, that it takes weeks, if not months, for that mindset to change, that you can always buy the dip.
So if you're moving more defensive, do you simply go into cash, go into money market funds that are still paying a pretty decent yield, especially compared to what people could have gotten over the last couple of decades?
Well, that's of course an option, except as anybody will tell you that it's very difficult to also get back into the markets, because just as nobody tells you where the top is, nobody will tell you where the bottom is. Monday was a case in point, right? The Japanese market was down 12% and Tuesday was up 10%, right? I mean, try to time this. As you're well aware, we have currently, I think, 1.4 billion in gold and gold miners. It's a space, although that was caught in the downdraft on Monday as well, somewhat at least, that historically provides extensive diversification. So you can try to address it with diversification. Obviously, there's no perfect diversification. You can address it with cash. There are all kinds of ways you can do it. Ultimately, anybody has to be comfortable with the sort of exposure that they have. And I would urge anybody to not assume that what happened in recent years is exactly how it's going to play out going forward, because we have a lot of unwinding of a lot of unusual things. We also have much more micromanagement by the Federal Reserve. So there's going to be a tad different. I personally I stopped adding to my traditional equity portfolio in my personal side a long time ago, and then recently checked that I don't have any Max 7 exposure in my portfolio. And so I've been taking it in steps. I do have more cash than I would typically hold, but it's not like in 2008 and 2007, for example, late 2007, I sold all my equity portfolio because I was extremely concerned. I've gotten much, much more conservative than I have, but I'm not hiding under a rock, so to speak.
Yeah, Axel, it doesn't seem like it's a crash environment, more of a corrective environment for the markets and maybe letting some of the hot air out of the markets and the valuations. But it seems like there has been a defensive trade. To your point, more people have been going to cash on the sidelines. There is the move into gold that's done well, despite a lot of what people would have thought of as headwinds. Now things are switching to more of a tailwind environment where we're going to see the rate cutting cycle start off, many people believe, starting in September. The market had factored in this rate cutting cycle way early, almost a year ago now. They were already gearing up for this rate cycle, and most believe it's going to be a series of cuts and that they're going to have to cut at every meeting. What camp are you in? Is this just going to be, an initial 50 basis point or 25 basis point cut, and then that's that? Or do you think it's going to be a series of cuts, and have the markets been right to anticipate the Fed coming to the rescue?
Well, this is the most forecast recession ever, and as you point out, much might be priced in. What historically happens, and I don't think this time is any different, is the market prices in a certain number of cuts because the economy is slowing down, and then surprise, surprise, the slowdown is more significant than previously anticipated. There's a lag effect with Fed policy. We are in a tight environment, and we haven't seen credit spreads really blow out, the junk sector, so to speak, has still been able to borrow. When that happens, it will get a more serious attention by the Fed. The Fed hasn't been concerned about it because we are at 5.5% at the target rate for the federal funds rate. And so they think they have plenty of room to cut. But it also means that I wouldn't be surprised, and indeed it's my baseline, that the Fed will cut more than is priced in because this economy will be weaker. And if you translate that to the markets, there's of course a context in which this is happening. It is when you have a harder landing that historically is not good for risk assets, the traditional S&P 500, and it's the sort of environment where the gold miners tend to thrive, where the price of gold tends to thrive. Now, the price of gold has held up, so is there still more room on the upside? That's a fair question. And on the gold mining side, though, that hasn't gotten, although that sector is up, it's not up by any stretch of the imagination as much as you would expect given the price of gold. And so the traditional diversification into that space, in my assessment, may well work if history is any guide. Keep in mind that space is extremely volatile. And so with just a little bit of diversification, you might be able to achieve quite a bit. But yes, I do think that this Federal Reserve will cut more than is currently priced in. And by the way, as we're talking, earlier in the week, there was a 50 basis point rate cut priced in for the September meeting. Now it's kind of 1.5 or so. But 3 rate cuts by November, 4 in December, 5 by January. That's currently priced in. And so the market has turned decisively more negative on the economy, and with that, increased likelihood of more significant cutting.
Yeah, in all fairness, we've seen the markets anticipate more cuts over the last couple of years anyway. These predictions change a lot, but it does seem like the markets, they always want more rate cuts, right? The markets consistently think, they've been trained to think that rate cuts are good. That'll make assets go up. It all depends what environment those rate cuts come in. You mentioned the gold miners then. Let's get right into the miners. Large miners broadly are doing pretty well. The higher quality, let's say mid-tiers and juniors, are doing fairly well. But again, it's still a tough market out there. It's a stock picker's market for these mining stocks. Axel, what drives more interest into these stocks? And have we seen, in your eyes, any more interest into some of the ETFs? Any movements behind the scenes that you've noticed that gives you some encouragement that more money, more people are paying attention?
Yeah, so first, one more comment on the previous topic, whether the Fed comes to the quote-unquote rescue. The Fed is not going to come to the rescue simply because equities are down. The Fed is going to come to the quote-unquote rescue when they see credit spreads blow out, when they see systemic risk, when the wheels fall off. So when the stress broadens, so to speak, from a mere correction. To the question on the mining sector, yes, the interest has picked up. On the physical gold side, there's been some inflows in recent weeks. Nothing dramatic, but a reversal of the trend. On the gold mining side, interest has picked up. I think what's going to drive that more is that other ways of diversification are going to be more disappointing. As a reminder, Bitcoin, for example, sold off quite sharply early in the week as well, acting much more like a risk assets than a quote-unquote safe haven. Given the extreme volatility, of course, we can't call it a safe haven in the crypto assets. But to the extent that the gold miners do well and all the other things line up, we may well get some speculative money into that space. And given the low liquidity in this market, that can lead to some extraordinary gains. And so I do think that what will get people's attention, if the Mag 7 don't do well and the miners do very well. And historically, of course, the junior miners have a higher beta. They're far more volatile. That said, when money first goes into that space, it tends to go to the big companies first before it spreads to the lower ones. These junior mining companies have realized that the big boys don't seem to have too much of an appetite to acquire them. I think part of that is the big guys have gotten too big, and it's just not worth it to acquire the smaller ones. They rather go to some projects, some copper gold projects that are just bigger, where their resources can be deployed at a scale. And so what we've seen more on the junior side is mergers amongst them. Some of these companies are now merging the exploration companies with the producing companies so that they try to self-finance themselves. So they're getting creative. There's some activity happening. as interest is picking up, as I would think it will continue to as this economy is evolving, I wouldn't be surprised if these companies act as they have historically and rewarding the patience of investors in this space.
Well, Axel, I'd like to contrast the movements in the gold, the larger senior producers and mid-tier producers that are in the gold ETFs with the silver stocks, the mid-tiers and the seniors that are in the silver ETFs. And just the response we saw in the market, with gold, GDX got up to a new 52-week high just in July in the GDX, and same thing in the SIL and SILJ. So everything was doing well, but the silver stocks have rolled over a lot harder than the gold stocks. The gold stocks in general have, gone up 50%, even 100% in some of the better companies. The silver stock shot up even more. They shot up 100%, even 150%. Some stocks that are mid-tiers even shot up 200%, but they've all rolled over very hard the last couple of weeks, a lot worse than the gold stocks. Obviously, so has the silver price, but do you read anything into the differences between the gold stocks and the silver stocks?
Well, silver's curse is, of course, the industrial use of it. And that just makes it much more volatile, and that makes it sensitive to swings in the economic outlook. And while on the one hand, its intrinsic volatility as a tailwind as rate expectations, cut expectations increase, the economic headwinds that might reduce the demand for silver just outweigh that at times. Also keep in mind that on the mining side, these price moves are often discounted quite extensively. And so, yes, it's an extremely volatile space. It's also difficult to get, of course, pure silver plays and good silver mining companies on top of that. And so it's a very difficult space. We are very selective in that space in our own work as much as I may like silver, but it's just a very difficult space to buy the mining companies in.
Well, even recapping some of the recent earnings reports, I thought that these silver companies should be making more money, even if they're not pure silver, then they have a gold component to it. Last quarter, we saw high prices for both. Costs didn't seem to creep up that much. So why can't these silver companies start issuing some noticeable earnings reports?
Yeah, it's a good question. We focus on, I can tell you on the earnings reports we followed on the gold side, we have seen some very promising cost reductions, costs coming in less than expected. So as I mentioned, right, it depends on how well these companies are managed as well. Also, these smaller companies, you just need one little item there that has a disproportionate impact on the earnings. It's not like these large companies that can spread the costs and mitigate some of the risk of any one issue. You just need to have a screw missing somewhere, and your earnings report is going to go off on the wrong end, right? But on the gold producer side, we've seen several where we see that the cost inflation we had seen is getting under control. And of course, what will happen is that then the higher gold price in particular for those companies is going to be beneficial.
Well, Axel, you brought up that if the generalists start seeing gold stocks making money because their margins have increased, you have margin expansion narrative instead of a margin contraction narrative, that it may get more attention. When you contrast that with some of the earnings reports we're seeing in the general equities, do you think there's the chance for the gold stocks and maybe the silver stocks to bifurcate from the general markets, even if they were to correct? Could the higher metals prices levitate the precious metals equities different than general equities?
Well, that's, of course, the thesis. That's usually what happens when there's an economic slowdown. Risk assets, traditional equities perform poorly. The miners perform well because they do well in anticipation of a more dovish Federal Reserve. And that's usually how it plays out, right? And that's part of the reason why the miners are often used as a diversifier. As we discussed earlier, as Corey pointed out, cash is, of course, the safe way to diversify, and that works for some people. But some people want to have a more speculative diversification, and that's exactly why money tends to go into this space when there's a recession. And it's one reason why I think it does matter whether it's a soft landing or hard landing, because in the soft landing, historically anyway, the S&P 500 can do just fine. If the landing is harder, then the S&P does poorly. Now, of course, the context we have, aside from this discussion of how hard landing is going to be, that the S&P 500 is very top heavy, with the MAX 7 having just outperformed so dramatically. And so one other place, of course, you can go to small cap value, which doesn't have the Max 7 in them. They haven't done as well in the recent years, but part of it is because we haven't had that recession, right? And so there are other ways other than gold mining and cash one can diversify. I'm not trying to pick any one of them. I don't have a crystal ball. I would just, again, encourage investors to stress test their portfolio.
So, Axel, if we take a step back here, and as much as we focused our careers, a lot of our careers around the metals, and a lot of the people listening to this show are very much into precious metals and the underlying stocks, we do need to accept that markets do change, that they grow up in a way. Is there a potential here that we have seen markets diversify, change so much that investors, while they might come into the precious metal stocks, there are other options out there for them to diversify, and maybe even those highs that we saw in something like GDX back in 2011, which we're still about 50% away from. It's a different market right now, and maybe we won't see that fervor come into the sector because of the other options investors have.
Well, markets rhyme. They don't repeat. They don't repeat in exactly the same way. A key structural thing that has changed is that we have a lot more micromanagement of the economy with the Federal Reserve. The most notable thing is the rescue package they gave a year and a quarter or so ago to the small banks, where they converted this acute problem of having mismanaged interest rate risk and the commercial real estate exposure to a more chronic problem. And so it's that sort of thing that I think does have an impact in the markets. Clearly, one thing that's different is that some of the big tech companies have just dramatic cash flow generation, and so they're not interest rate sensitive. Similarly, of course, some consumers are not as interest rate sensitive if they have these super locked in mortgages. So all of that, of course, has an impact. And then just more broadly speaking, right, we talk about diversification. One of the things in the gold space we talk a lot about is that the price of gold has a near zero correlation to equities, but that's in the long run. In the short run, it can be positive, it can be negative. Sometimes diversification works, sometimes it doesn't. Investing is supposed to be frustrating, right? There is no guarantee that any of this works. It's when I think about diversification, I'm thinking about all of the above, right? I'm thinking about, I have more cash than normal. I have more gold mining than many other people do. I have more small cap value than many others do. I have invested in forest and other things on the physical side, right? And so diversification can mean many different things. None of us have a crystal ball. I think the role we can play is to alert people that, hey, have you considered this risk? And have you considered this opportunity? Does this work for you? But I think one of the things you're alluding to, has crypto stolen the show? Well, I think that the speculator has been less active in the gold mining space than they historically have been. It's part of the reason why the volatility has been less. And also, of course, many people were disappointed and disillusioned in the mining space. And that said, the speculator is not very loyal and will come back should the gold miners really take off. And so anything is possible, right? But yes, one should always be humble and recognize that the market this time around might just act a little differently.
Well, Axel, and just tugging on that string a little bit further, when you brought up the cryptos, I was looking at something yesterday where there's actually not just cryptocurrencies like Bitcoin or Ethereum that are more established and have more of a track record, at least since 2008, which is not a long track record, but it's at least something. But there are new ones coming out all the time that are now called meme stock cryptos. And so they've taken the excitement of meme stock investing, which is a relatively new phenomenon, and they've done it where these coins have actually no value at all. They're not trying to be a store of value. They're actually just funny memes, but they're also cryptocurrencies, and those are still catching a speculative bid. You saw the meme stock environment, the crypto environment, but you've also seen it in biotech. To your point about small caps, there's the small cap value side, but there's also the small cap, very speculative side. Has the speculation broadened out so much that maybe investors won't ever turn back to the juniors in particular because they're just seeing other opportunities to speculate in something that's easier to understand, because mining is not easy for the average investor to get their hands around?
Well, the way I look at it is the 2000s. Again, pet.com is not around anymore, but Google is, right? And so similarly, some of the things you mentioned suggest to me that we're not at the bottom in the market, and that there is a speculative frenzy that's alive and well. Whether that means that money will go to the junior miners or not is anybody's guess. I would think it will, because ultimately investors want to participate in the speculative upside, and that's what some of these junior miners are. They're literally options of striking gold and developing those mines. They will go through different periods of disillusionments and overexcitement. That is part of the cycle in that space. Are there fewer investors than before? Well, of course, one of the structural things that has changed is that this market is very much dominated by ETFs. ETFs are not well suited to fund the junior mining companies. And so, yes, it is somewhat of a neglected space, but that doesn't mean that you can't have more interest in that space, and the space can move very aggressively when that interest picks up. And so I think one needs to be cognizant of it, but there is a lot of damage, so to speak, that has been done for fundamental investors through the many years of zero interest rate policies. A lot of talent is not around anymore. That may well mean that the unwinding of the excesses will take longer, but I think there's always space for value. I mean, if you take Berkshire Hathaway, they're obviously not mining investors, but they just sold a big stake of their Apple investment in the public filings. I'm not giving a recommendation on Apple, but here's a company that's sticking somewhat to its guns. I mean, they used to never sell, and different management teams somewhat there. It's not just Warren Buffett calling the shots, but still, they are okay holding, I think it's 250 billion or so in cash, waiting for value to be there. So there is capital that's patient on the side while the media focuses on the speculators. There's always going to be space for any one particular investment strategy. And I think on the junior mining side, just as much. There is a time and place for it. And I'm actually quite excited with the sort of economic numbers that are coming out and the dislocations we see in the market that the interest will pick up.
Yeah, it's a very good comment there, Axel. And we do need to remember, right? Mining sector, these stocks, they're small in the whole scheme of things. Broadly, they're penny stocks. So just a little bit of money can still get them moving. I do want to quickly ask you about copper, though, because copper went on quite the run through April and May, topped out at over $5 a pound, and has gone almost straight down from that time. Now we're back under $4 a pound. Is this simply recession fears taking copper? What's your outlook for copper? How do investors even play that market?
Yes, I mean, I am not going to give advice on copper trading, but yes, it's all of the above, right? It's overproduction, it is recession fears, it's all those dynamics, right? Anybody should be careful touching these things if they don't fully appreciate the dynamics in that space. Part of the reason I focus on the gold miners, it's just much simpler, because the moment you move even to silver, you have many more industrial components and copper, of course, as well. And so the analysis gets more complex. And yes, you can have these very significant sell-off in any one of these spaces.
All right, Axel, we're going to wrap it up here. Always great chatting with you. Thank you very much for taking time on our show. I will post a link to Merk Investments in the show notes. Everyone, thanks for tuning in to this weekend show. I know it was a crazy volatile week in the middle of summer, too. Seems like that's going to be the standard, the norm for the second half of this year as we move through the election in the U.S. and the rate cutting cycle. Whenever that starts and however aggressive that is, how will markets react? That is the big question. Everyone, thanks for tuning in. Please go back through our website, podcast, and YouTube channel by searching The KE Report. Listen to all our daily editorials and company updates, and keep in touch with us through email. Axel, everyone listening, thanks for tuning in. I hope you all have a great rest of your weekend.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.